Bonds have been going up and going down with all the volatility recently. Every move of the U.S. President Donald Trump affects the bonds market. For more on that, let's go to Ian Pollick, Managing Director, Head Fixed Income, Currency and Commodity Strategy, CIBC Capital Markets. Thanks for joining us today.
Thanks for having me.
So the Bank of Canada has left interest rates unchanged today. Has this moved the bond market at all?
A little bit. Expectations going into the Bank of Canada today were a bit mixed. And really, this was quite a 50-50 meeting. We had been expecting a pause. Let's call around 10 basis points were expected from the market. And it was really the narrative coming out from the Bank of Canada today that started to move the market. What you just said was very apropos. When you're in a dark and unfamiliar room, sometimes the best thing to do is to stand still. And so that seems to be what the Bank of Canada is doing, but that doesn't obviate further interest rate cuts down the line. Our own expectation is that the Bank of Canada will deliver 2 more interest rate cuts. But depending on the deterioration that we see in the economy, we could see an outsized cut in June of 50 basis points.
So as you know, the chair of the U.S. Federal Reserve also had some comments today and, said what a lot of people are saying, which is we're looking for some clarity before we decide if we're going to make any moves. And we're in that almost in-between period where we've had all this action on the trade war, but it hasn't really filtered through yet. But do you feel like the clarity is going to come? Because it could be just a continuous year of not knowing what's next.
I agree with that. And, for the bond market, it's not the clarity provided by central banking. It's the clarity needed from the administration. It's clarity from trade negotiations. And that's really why we were so terrified last week. When you have a situation where interest rates are rising, stock markets are falling, and there's no obvious shooting gun, that's when people start to ask really big questions. Typically when something breaks, you can find it in the bond market. You can see the footprint, whether it's in funding markets, whether it's in derivative markets. What was so interesting about last week is that you didn't see that. And so this is more existential. It's a very big existential question saying, well, what if the probability that I'm not going to get my $1 back from the US Treasury increases from 0% to 2%? Well, what should the bond market do? Well, I think we all got a preview last week.
Is that how you would characterize what was fueling that volatility last week in the bond market?
There's a lot of very popular reasons as to why the market was doing what it was doing. Some of that we've heard the most often include some Asian economies outright selling treasuries. We don't know that for sure. I would reject that largely, but we'll find out relatively soon with some of the incoming data. There was also some concern that some foreign investors just did not show up for the auctions in the United States last week. It's a lot of bonds that come to market and someone has to buy it. Remember, for context, foreign investors are 30% of the U.S. bond market. And so if they don't show up, then that marginal buyer has to shoulder more of that burden and we'll ask for a concession for it. Again, I think that a lot of this is just very reflexive, meaning that in the absence of actually knowing what happened, people seem to go to those very popular narratives and just attach themselves to it.
Let me ask you, because you said you are thinking that there will be 2 more cuts ahead in 2025. And what is your theory behind that? What are you looking at to happen in the next few months to allow for 2 more cuts?
Well, listen, I think it's already happening. I think the Bank of Canada has done a very good job at being very communicative. They've delivered 7 consecutive interest rate cuts. One of those was a non-standard size cut. The reality for the Bank of Canada is that this is an economy that is plagued with uncertainty. And so it's standing still at the same time across the country. Whether we see job losses or not, I think there's 2 competing narratives, and the bank is really trying to understand which one is going to win out. The first narrative is that growth is slowing, and the deterioration of growth, the lower potential growth of the economy, all that just means that maybe the economy needs a little bit more stimulus. At the same time, they're very worried about inflation. And so tariffs are inherently inflationary. When you provide reciprocal tariffs, they are inflationary. And we did have some cheapening of the Canadian dollar, which is inflationary. What we've actually figured out in our own models is that the overall tariff rate that is now being applied to Canada, if we make a lot of assumptions, for example, full compliance on USMCA proof of origin, the tariff rate's actually not that bad. It's about 8% on a weighted basis, so materially better than what people had been expecting. And that means that the inflationary impulse to the broader economy should be a lot lower. And so when you start to not have to worry about inflation and start to worry about growth, which is why the Bank of Canada paused today. They'll get a bit more clarity on that. And as they do, that's when interest rates will be cut to the lower end of their neutral range.
Got it. Okay, so are there any then unintended consequences of tariffs that you see?
I do. You know, these are very, very complex questions. And at its core, I think a lot about what tariffs are trying to do. And what they're trying to do is reorient global trade flows. You cannot change the flow of trade without changing global money flows. And so as the circulation of money changes, it's like flushing a toilet and all of a sudden the water goes the opposite way. It's something that you were not expecting. And it always creates an accident, and there will be an accident. And we've seen it time and time again, whether it was the Asian financial crisis in '97, whether it was the dot-com crash, whether it was the great financial crisis. Every time you have a very similar footprint, you have a liquidity accident, a backstop at a very expensive rate, and some lasting imprint on the market. And so somewhere in the system, you know, there's a handicapping that the intermediating ability of the system will fail at some point. That worries me quite a bit. I also worry on the other side, given the fluidity of just current trade policy, I do worry that some tariff countries may actually overstimulate themselves. And whether that's through a combination of interest rates falling too much from central bankers or fiscal policy that's responding too heavily in kind, we could be in a situation in 2026 where we have faster growth, higher inflation, and materially higher interest rates.
Ian Pollick, I do have to leave the conversation with you there, but thank you so much for joining us. Ian is the manager.